the SME sector, it's very diverse. But broadly, you know, a lot of SMEs are worried, they're scared. A lot of them have seen their turnover dry up, they've seen their markets disappear. But then again, you have sectors on a very much a sectoral by sector basis. You know, if you're a pub, a restaurant, in tourism or hospitality, you're in that former category, which is a perilous place. And I really do fear for, you know, those businesses, particularly, you know, as the government schemes, which have been very good heretofore, and there's many businesses that are only there today because the government are paying 80% of their wages. But there are other sectors that are quietly doing well. You've got medical devices, pharma, logistics, software. Even then, there's been a big shift in where the opportunities are. So there's been a move from the city centres, from the metropolis. There's booms in suburbia. There's booming businesses, the butcher, the baker, the candlestick maker in local suburbs, and they're all doing very, very well. And I think the sentiment is there for Irish people to try and support local businesses.
The SBCI was set up at the end of the last crisis to try and do three things: bring down price, bring in more competition, and make access to finance easier for SMEs. So that's really the bedrock. That's where we've been set up and what we've been set up to do. So we started very simple. We gave out liquidity at a discount, which worked for a very short period of time, but then liquidity was no longer an issue. So access to finance was the critical piece. So access to finance for us was actually beginning to get solved over the last couple of years by risk sharing, and by us allowing either the government to take some of the risk or getting European institutions to take some of the risk away from the SME. That it meant that the actual security levels dropped. There was an element of unsecured to be attaching, or unsecured lending to attach to all of our schemes. And this in turn should have made it easier for SMEs to borrow. So we're beginning to see that happen through the schemes, much more so than we would have done through the liquidity. So we believe that we're beginning to address that, and SMEs' attitudes to borrowing are beginning to change because they can now see that they can borrow with the strength of an 80% government guarantee behind them. The bank or the institution, like Linked, will take 20% of the risk, and it actually removes the need for personal guarantees and that, you know, that worry that people have had and SME owners have had, particularly since the last crisis.
But very interesting, while the appetite is there, having gone to the market to expand and look to the traditional banks back in 2019, looking at what the traditional banks were doing in 2020, they, in my opinion, they weren't building in the 80% guarantee that the government were giving. There was no difference between their application assessment in 2019 and 2020, and that was a little bit of bugbear of mine. You know, they didn't take into account that 80% government guarantee. And I think what's really been helpful to businesses is the likes of Link Finance, the credit unions, the permanent TSB, opening up the market, opening up the access to this very important funding, I think will be a great help to the SMEs going forward into 21 and 22.
In the context of the credit guarantee scheme, a couple of things that people or businesses need to understand is that this is there to support businesses as they emerge from COVID. All right, it has been extended from, the original deadline was December 2020, it's gone out to June 2021, it's likely to go to December 2021. It's 5.5-year money, so it allows people time to actually, you know, borrow now and pay it back over, you know, a medium-term period of time, which is actually kind of suitable for a lot of Irish SMEs. It also allows businesses to refinance. So if somebody took out a COVID-19 working capital scheme, you know, immediately the COVID thing hit, it allows them now to go back and refinance that initial 3-year loan over a longer 5.5-year period. And there's also the ability within the COVID-19 credit guarantee scheme that 30% of any new loan amount can be used to refinance other existing debt. So if you had a loan of 100 grand, or if you apply for 100,000, 30,000 of that loan could be used to pay off a debt that pre-existed COVID-19. The people that I see, you know, are the people that have spoken to their accountants, who have gotten their business plan ready, who have actually engaged with their advisor. You know, as you said, I used to work in retail banking, and as a branch manager, you kind of were the first person that a lot of your customers would have come to. That's no longer available in a lot of cases now. You can't have that one-to-one. You know, definitely with the bank, you can have it with Link Finance, but you can't have it in a lot of cases with your bank manager. So your accountant has actually really become that trusted advisor piece. And I think that's critical in any of the successful applications that I've seen, because there's a huge difference in the quality of application that comes into any financial institution.
Yeah, well, this is very practical, and I've put it into my effect in all my business. So I would have employed 100 people in multiple businesses and companies throughout Dublin and Leinster. And what I did was I went to weekly payments. So I went to my rent, my landlords, any debt that I had, any large supplier, and I went weekly payments from March last year. And I also then sanctioned every single payment myself. So nothing left the business bank account unless I sanctioned it myself, and actually did the payment on my app, which meant that on Friday evening at 5 o'clock, I knew exactly how much money I had in my business. The second point is that every small business is going to have some element of debt, some creditors that they need to pay. And what I would suggest is that knowing whatever income that you have coming in for the last year, or predicting what you're going to have coming in for this year coming, is that engage with your creditors. Be front up, say, this is what I have coming in. This is exactly what I owe you. Here's a 6, 9, 12-month payment plan. Don't duck your head in the sand. Get ahead of it, reach out. And 99% of companies, if they know they have a guaranteed amount of coming in, pay off, or sorry, if a creditor knows that they have a set amount coming in every week, they're more likely to engage you.
Well, I'm going to say it again, is don't run out of cash, because I think that's the most perilous thing for any SME, and you know, any, regardless of what sector you're in. So that's number one. I'd say if you can avoid it, don't put yourself under pressure. Borrow more than you need. And like John said there, I'm a huge believer in having a provision for funds, the rainy day stuff, the stuff that you think you may not need, going back again to get it reissued or whatever. But knowing that you have that cushion to fall back on allows an SME to sleep at night.